What's up, everyone? It's Scotty with MoneyVest. So the 10-year yield is dropping quite aggressively here. We are back under the 4.6% threshold at the moment. And in this video, I wanted to basically break down the comments from the recent Fed speeches. So we've had Christopher Waller, Neil Kashkari, Philip Jefferson, Mary Daly. A lot of them have actually spoken over the last 2 to 3 days. And that's exactly what I break down in this video. Go over exactly the comments from these Fed members and why there is a possibility that the yields may have topped, but at the same time, there's some other reasons as to why it's not. So I'm going to go over everything in this video. Hope you enjoy it, find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. And the link to our Discord and Patreon is going to be down below if you're interested in, of course, joining our MoneyVest community and our platform. And we'd love to have you on board. I opened up a couple more spots for you to join. So first things first, I want to break down this right here is the detailed 2023 FOMC board members. And right now, the permanent voting members, of course, we've got Jerome Powell over here. We've got Lael Brainard. We've got Michael Barr, Christopher Waller, Michelle Baumann. We got Lisa Cook and Philip Jefferson, right? These are the board of governors, and they're also voting members in the FOMC. And then we've got voting districts, John Williams from New York, Chicago, Austin Goolsbee. We got Patrick Harker, Lori Logan, and Neil Kashkari from Minneapolis, Dallas, and Philadelphia. And these right here are the non-voting districts, right? So whatever Susan Collins says or Mary Daly says, Loretta Messer says, yes, may influence some of the other members, but it's not really holding a lot of weight as opposed to something that Philip Jefferson says or, Christopher Waller says or Neil Kashkari says, because they do control the voting districts and they are also going to be voting members on the Board of Governors as well. So you can see that these right here, purple, Board of Governors and permanent voting seat, and then the ones in orange are going to be voting districts. So 4 voting regional presidents, and these right here are the non-voting districts, which are all the way at the bottom. So in the last few days, we've had Mary Daly speak, Neil Kashkari, Christopher Waller, and Philip Jefferson. That's exactly what I break down in this video. So first, let's just start with what Philip Jefferson said. He says, and I quote, "Officials are in a position to proceed carefully in assessing the extent of any additional policy firming that may be necessary," a language that we have already heard, something very similar to Jerome Powell. And he says, "Looking ahead, I would remain cognizant of the tightening in financial conditions through higher bond yields." So what they basically mentioned is that the higher treasury yields may have lessened the need for further rate increases. In other words, the higher the yields go, the more impact they're making on the economy. In other words, the financial conditions are tightening on their own without the need for the Federal Reserve to intervene. You know what I mean? So like what they're basically saying is the treasury yields going higher is doing the Fed's job. And 3 Fed officials have said in recent days that the rise in treasury yields may have lessened the need for further rate increases. So it's possible that in the SEP that we get in December, it's possible that more and more FOMC members now move more towards potential rate pause and a rate cut. Right now, we know that looking at the SEP, the Summary of Economic Projections, majority of members are expecting rate increases, at least one more rate increase in 2023. So if we come over to the Federal Reserve's website and go over to monetary policy, meeting and calendars, and you can scroll down to the most important and recent Summary of Economic Projections. And this right here is the dot plot, which basically did suggest that majority of members, so in 2023, you can see right here in 2023, majority of members still expect interest rates to go up one more time by 25 basis points, sitting at just over 5.75 to as much as actually 5.5 to 5.75%. And right now there's 6-7 members that are expecting rates to stay where they are and basically see us out in 2023 with a pause. So, that right there in the future meetings, as we continue to kind of get this new information, there's a possibility there's a shift in the overall consensus for where interest rates are potentially headed in 2023, not to mention in 2024 as well. So moving over to this right here. So that's going to be from Philip Jefferson, but now Christopher Waller, he's a little bit more hawkish. Okay, so Christopher Waller is a little bit more on the hawkish side. By the way, this report also does show us the H or the N or the D. So over here, policy inclination. As of October 2022, you'll notice H is a hawk, N is neutral, and D is a dove. So what we have over here, Jerome Powell is probably going to be an N, or he's H. He's a little bit more on the hawkish side. Lil Bernard is going to be a dove. Michael Barr neutral. Christopher Waller a little bit more hawkish. I'll go over some of the comments from him yesterday. And then we got Michelle Bowen hawkish, Lisa Cook neutral. Philip Jefferson's also a little bit more on the neutral side. But Christopher Waller basically said that the Federal Reserve needs to continue on their primary responsibility to bringing inflation down to 2%. In other words, price stability is the primary responsibility of the Federal Reserve, and that is why we have taken forceful steps aimed at reducing inflation and why we will stay on the job to achieve our objective, and in considering the appropriate monetary policy response needed to return inflation back down to 2%, I find it useful to draw on the findings of the policy rules literature, and more specifically the Taylor rule or the Taylor principle, which Jerome Powell has also talked about previously, and the notion that the deviations of inflation from target should likely be met by one-for-one response of the Federal Reserve's rate as well. So in other words, if inflation goes up, they should also increase interest rates. If inflation goes down, they can start cutting interest rates, and a response that helps ensure that the real interest rates are increased in a policy tightening. So real interest rates, meaning interest rates minus inflation, continues to increase, and it's still positive in order to bring inflation back down. Now, when it comes to Neil Kashkari, he is going to be, from that chart, hawkish as well. So that's exactly why he mentioned that the Treasury yield increase may not be enough to lessen the potential for another rate hike from Federal Reserve. So what he says is that it's certainly possible that higher longer-term yields may do some of the work for us in terms of bringing inflation back down. But if those higher long-term yields are higher because of their expectations about what we're going to do has changed, then we might actually need to follow through on their expectations in order to maintain those yields. And he says it's hard for me to say definitively that because they moved, we don't have to move. So we got a couple hawkish prints, basically speeches, and one a little bit more on the neutral side from Philip Jefferson, but the yields nonetheless are moving back lower because of what I believe Neil Kashkari said and Christopher Waller said, because because they don't believe in the idea that, okay, the higher yields are actually doing the work for the Fed at the moment. Because as we know, the cost of borrowing goes up, pegged against the 10-year yields, and if that continues to go up, that's going to put more and more pressure on the economy, which is going to probably lessen the potential for Federal Reserve to increase interest rates, because the Treasury yields are doing the job for the Fed. But a couple members don't actually believe that's actually the case. And it's more specifically, they're going higher on the back of fiscal deficits and more supply kind of hitting the market as opposed to the level of demand that we're at. So, that's one of the reasons why the markets are a little bit more volatile right now, especially when it comes to the 10-year yields. They are pushing up they're actually pushing down over 1.4%, but TLT is higher, a little bit closer to 1.3%, not to mention TMF. I ended up picking up more TMF yesterday, picked up close to 300 shares, picked up some more shares this morning, and right now it's up over almost 4%. So it is incredibly oversold. There is a tactical play, in my opinion. There is opportunity with respect to the bond market being having its worst sell-off in history. There is opportunity, but of course, we have to be very, very mindful of what's going on in the economy with respect to interest rates, inflation, economic growth, labor market. Everything is going to be very, very important in our understanding of how bonds are going to be trading and where they're potentially going to go. Now, I also mentioned that in order for the yield curve to uninvert, the short end of the curve has to come down and the long end of the curve has to go up. Now, short end of the curve is very much dependent on interest rates as measured by the Federal Reserve, so federal funds rate. If that rate gets cut, then the short end of the curve, we're talking anything that's under 1 year, is going to start coming down. And anything that's on the longer end of the curve is very much dependent on inflation and economic growth, and not to mention the supply that's being given out by the fiscal policy. So in order for this to uninvert, the short end has to come down, meaning the rates need to get cut, and the long end of the curve needs to start going higher, back up over the short end so that we can uninvert. But that's also historically been a recession indicator. And the only time the Federal Reserve is actually going to be cutting rates, and that's going to be an incentive for them to cut rates, is if the U.S. economy is indeed in a recession. So that's when this starts to uninvert, starts pushing higher, because short end's coming down and long end's pushing higher. But that also does signal, or is during that time, doesn't necessarily signal, but is during a time of a potential recession as well. So, that's where we are. I mean, in 2024, if a potential recession hits, there is possibility for this, rate spread or the yield curve to uninvert, and then for the TLT, TMAV ETFs, the bond price ETFs to start moving higher. And there's possibility that bonds end up outperforming for some time against equity prices, given how significant the sell-off has been in the bond market. So I hope you guys enjoyed this video and found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. And as always, happy investing. I'll see you all in the next video.